When people hear the word volatility, they usually think of danger. A stock falls 5%, then rises 4%, then falls again. The price is moving everywhere, so naturally it feels risky. But I think it helps to separate two ideas. Volatility tells us how much the price is moving or how much movement the market expects. Risk is something deeper. Risk is the possibility that I permanently lose money or that the investment does not work out the way I expected. Those two things are related, but they are not always the same. Imagine I own a financially strong company with growing earnings, healthy cash flow, little debt, and a durable competitive advantage. If the stock suddenly falls 20%, the volatility increased. But if nothing important changed in the business, did my long-term risk really increase by the same amount? Maybe not. In fact, the business remains strong and the valuation becomes more attractive. The lower price may actually improve my future return potential. Now compare that with a company whose stock barely moves, but the business is slowly deteriorating. Debt is increasing, customers are leaving, cash flow is weakening. The stock may look calm, but the underlying risk may actually be rising. That is why I do not want to confuse a moving price with a broken investment. Volatility can be uncomfortable, and it absolutely matters, especially when my position is too large or when I need the money soon. But for a long-term investor, the bigger question is always, what is happening to the business? I've learned not to ask only, how much is this stock moving? I also ask, what could permanently damage my capital? Volatility tells me that the ride may be rough. Risk tells me whether I may never reach the destination. And understanding the difference can completely change how I react when markets become uncomfortable.